If you're in the market for a mortgage, we're going to be going through the tool that the banks use to set the 5-year fixed mortgage rate. We know that interest rates are increasing and mortgage rates too will follow. So if you have to renew anytime soon, you can use this tool to help you determine what is the best for you. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on for content similar to this. We're going to be starting out by looking at where the 5-year fixed mortgage rates here in Canada sit today. And we're going to go to a site, wowawawa.ca, for the 5-year fixed mortgage rates. And we can see on the low end that we're at high 3% range. As we start going to more reputable lenders, your big six banks, we can see that the rate starts to increase. We have BMO coming in at the lower end for the big six at 4.36 for a 5-year fixed mortgage. As we continue to go along, we start seeing the other competitors come into the market going as high as about 5% for National Bank. And this is something that is very concerning. We started to see a little bit of a cooling off in the housing market, and a lot of people are attributing it to the higher mortgage rates. People aren't able to go and get money for as cheap as they have in the past. So how do these banks set what the rate is going to be? Well, something that I've recently learned is that they use the Canada 5-year bond yield. So if you type into Google Government of Canada 5-year bond yield, you'll be able to get an indication of where mortgage rates are today and where they could potentially be going in the future. We'll take a look at that a little bit later, but let's just get a little bit more context as to how this works. So many factors can affect fixed mortgage rates, but the single biggest factor is the Government of Canada bond yields. Banks actually use the 5-year bond yield market to determine their fixed mortgage rates. They use the forecasted earnings from bond investments to cover the costs of the possible losses incurred through the mortgage market. So we know that the banks are essentially lending out money, they're collecting that percentage, and they need to figure out how much possible return is out there. So if they're using this as the basis, that's kind of their profit margin. Now, we really want to determine how much of a higher yield that they're making. So we go down here and we see in a normal market, the average spread or markup of a fixed mortgage rate above the secured government bonds is roughly 100 to 200 basis points. That's 1 or 2%. And that markup is called the spread relationship, and it'll widen and contract in response to the range of market conditions, such as the risk of rising inflation, investor appetites, product supply, and competition from other investment opportunities like corporate bonds or equity markets. So we know right now we're going through a period of high inflation. So we could see that the markup is a little bit higher than the 1 or 2% that is traditionally out there. So if we go and we take a look at what the 5-year bond is sitting at today, we can see that it's at 2.7%. So when we look at the 5-year for the big six banks, we can see that they're around 4%. So that gap is actually 1.3 that they're targeting today. And we can see in this last year that this chart is definitely on an uptrend. And we know this because the Bank of Canada is coming out and they're saying, hey, we're trying to raise interest rates to a neutral range, which is 2 to 3%. We're at about 1.5 now. So we can expect that the Bank of Canada will continue to increase that rate. In turn, the 5-year bond will increase, and in turn, the banks will then adjust their mortgage rates accordingly. So we could expect that the 5-year fix could continue to go higher. Now, I'm not here to give you what is best for you. Obviously, you have to take into account your own situation. we've covered in a video in the past of over a long run, over 10-20 year period, what is better for you. And I'll link that video above in regards to a variable rate mortgage or a fixed rate mortgage. So check that out if you want to learn a little bit more about what may be best for you. But there's some people that prefer the fixed. They like to know what their costs are. And it's definitely something to be further investigated. And especially if you have to renew anytime soon, use this as your indicator as to where rates could potentially be going. Now, over the long run, as we go back to this chart here, we can see in 2010, right before that, before the economic crisis, the rates were above 4%. So we're heading back into that area where the rates are going higher. It seemed like for the past decade, rates would continue to be so low for so long, but it's almost, we're really breaking out of the pattern that we've been in the past 10 years. So there's a lot of different speculation out there, but use this 5-year Canada bond as a guide as to where rates could potentially be going. So I just wanted to throw that on your radar, especially if you're renewing anytime soon, so that you can get some indication as to where we've been before, where we're at today, and where we could potentially be going. So if you enjoyed the video, make sure to leave a comment down below what your thoughts are on the current state of the mortgages, housing market, whatever. And if you're still here with me, don't forget to hit that like button. I definitely appreciate your support. I hope you all have a great week in the markets. Happy trading.